I have spent the better part of my life inside the world of wealth, when not just studying it from the outside, reading about it in textbooks or analyzing it from a distance, but living inside it, breathing the same air as the people who built it, watching them think, watching them decide, watching them react to the same circumstances that would send ordinary people into panic or paralysis. And after all of that time, after all of those observations, after sitting across tables from some of the most financially successful people in human history, and having the kind of conversations that do not make it into press releases, I can tell you with complete confidence that there is one thing, one single thing, that separates the people who build real, lasting, generational wealth from the people who spend their lives working hard and arriving at the end with very little to show for it. It is not intelligence. I have known brilliant people who died broke, and people of ordinary intellectual ability who built extraordinary financial lives. Intelligence is not the separator. It is not discipline. Some of the most disciplined, hard-working, self-denying people I have ever encountered are still trading their time for money at 60 years old, exhausted and anxious, and nowhere near the financial freedom they have been working toward their entire lives. It is not education. The research on the correlation between formal education and wealth is far weaker than the education industry would have you believe. It is not even ambition. The world is full of ambitious people who want financial freedom desperately and never get meaningfully closer to it, regardless of how intensely they want it. The thing that separates them is a single shift in how they perceive money itself. What money is, what it does, what it is capable of, and what their relationship to it should be. This shift sounds simple when I describe it. It is 2 sentences long. But do not let the simplicity fool you, because those 2 sentences contain a reorientation so complete, so total, so structurally different from how most people think about money, that making the shift genuinely, at the level of behavior, rather than just intellectual agreement, typically takes years of deliberate effort and repeated confrontation with deeply embedded habits of thought that were formed before most people even understood what money was. Here is the shift. The rich do not see money as something to be earned and spent. They see money as something to be deployed, and they understand that every dollar they own is either working or wasting, that every dollar is either generating more dollars or losing its value by sitting still, that the only question worth asking about any sum of money is not how much it is or how hard they work to earn it, but what it is doing, where it is going, what it will produce, whether it is employed or unemployed, whether it is moving toward more or drifting toward less. This is the shift. Everything else, every strategy, every investment vehicle, every tax optimization, every business structure, every financial decision the wealthy make differently from everyone else, is downstream of this single change in perception. I want you to feel the weight of that word, downstream, because it means that if you do not make this shift, all the other advice is partially useless. You can have the perfect investment portfolio and still not make the shift. You can have a financial advisor, a retirement account, a side hustle, a budget spreadsheet color-coded by category, and still not have made the shift. Because the shift is not a strategy. It is the lens through which strategies are evaluated, chosen, and executed. And the wrong lens produces the wrong evaluation, even with the best strategies in front of you. It is like having a perfect map, but using it upside down. Every direction it tells you to go takes you further from where you are trying to be, not because the map is wrong, but because your orientation to it is. The shift is the orientation. Get that right, and everything else snaps into alignment. Get it wrong and nothing else quite works, no matter how hard you try, or how carefully you follow the advice. Now I need to unpack this carefully, because the words are easy, and the reality is profound, and I do not want you to hear the words, nod along, and then go back to making exactly the same decisions you were making before, because nothing actually changed in the part of your brain that drives behavior. The intellectual understanding of this shift takes about 30 seconds. The behavioral integration of it takes years. And that gap between knowing something and being changed by it is where most people get stuck. They understand the concept. They even explain it well to other people. But their decisions at 11 o'clock on a Tuesday when they have a little extra money and a small temptation and nobody is watching, those decisions still come from the old model. Because the old model was installed first. It runs deeper. It has more history behind it. And without deliberate, sustained effort to replace it, it continues to generate the automatic responses that shape actual financial outcomes. So, let us go slowly. Let us go deep. Let us look at what it actually means to see money as something to deploy rather than something to earn and spend, and why that difference touches every corner of your financial life in ways that compound across decades into outcomes that are almost incomprehensibly different from each other. Most people, The vast and overwhelming majority of people are taught one thing about money from the moment they are old enough to understand what it is. They are taught that money is the reward for work. You do something of value for someone else. They give you money. You use that money to buy the things you need and the things you want. This is the fundamental transaction of economic life, and there is nothing wrong with it as far as it goes. The problem is not the transaction itself. The problem is that, for most people, this is the entire model. Earn it, spend it, earn more, spend more. The cycle repeats until the earning stops, at which point the spending must also stop, which is why retirement feels like a cliff rather than a plateau for most people who reach it, because it is. The income stops, the assets are insufficient to replace it. And the person who worked for 40 years discovers that all they really built was a habit of dependence on the next paycheck, scaled up or down depending on how much they earned, but structurally identical in its vulnerability. What is particularly insidious about the earn and spend model is that it rewards itself as it goes. Every paycheck confirms that the system works. Every purchase delivers immediate satisfaction. Every upgrade in lifestyle as income increases feels like progress, feels like the reward arriving in real time, feels like proof that the path you are on is the right one. And so the model is never seriously questioned, because it never looks broken until the very end, when there is no longer enough runway to correct course. The person who retires at 65 with insufficient assets did not make one catastrophic financial decision. They made thousands of entirely reasonable, entirely understandable, individually harmless decisions, each one consistent with the model they were operating inside, and the cumulative effect of those decisions is a cliff. Not a mistake, a system working exactly as designed, producing exactly what it was built to produce, which is not wealth but comfortable consumption, followed by precarious dependence. The wealthy inherited a different model, or discovered it, or were taught it explicitly, or built it through painful experience. And the model is this: money is not a reward for work. Money is a resource that can generate more resources, and your job is not to earn it and spend it, but to accumulate it and deploy it in ways that cause it to multiply. Work is simply the mechanism that delivers the initial capital. It is the launch pad, not the destination. You work to accumulate, you accumulate to deploy, you deploy to generate returns, and you reinvest those returns to compound. The cycle is completely different from the earn and spend cycle, not in the initial step, but in every step after it. And because wealth is exponential rather than linear, a different cycle does not produce incrementally better results. It produces results that are so much better that they eventually become incomparable. Let me make this concrete with a number, because numbers cut through philosophical language in a way that nothing else does. Two people, same income, same starting point, same city, same cost of living, same family structure. Person A operates on the earn and spend model. They make $80,000 a year. They spend $75,000 a year on a comfortable, reasonable, not extravagant life. They save $5,000. They put it in a savings account because saving feels responsible, and the savings account feels safe, and the financial advisor at their bank told them this was sensible. After 30 years of this, they have perhaps $150,000 in savings, because the savings account barely keeps pace with inflation, plus whatever their employer contributed to a retirement fund. They never thought about very carefully, because the statements made them feel anxious, and they had more pressing things to deal with. They stop working at 65. Their savings last perhaps 5 to 7 years, if they are careful. Then they are dependent on social programs, and whatever help their family can provide. They are not poor, they are not irresponsible. They followed the model. The model just did not take them where they needed to go. Person B operates on the deploy model. Same income, same basic lifestyle. Because they understood that the difference between the models is not about suffering through deprivation, but about asking a different question of the same money. Instead of saving the $5,000 in a savings account, they treat it as capital to be deployed. They invest it automatically, every month, into a diversified index fund. They never touch it. They add to it whenever possible. Whenever a raise arrives, or a bonus comes through, or an expense disappears, the differential goes immediately to deployment. They treat it not as savings but as an army of soldiers whose only job is to go out and recruit more soldiers. And they never, under any circumstances, confuse their investment account with their spending account, because in the deploy model, those two things are not even in the same category. One is capital, the other is consumption. And capital is not available for consumption, regardless of how much of it there is, or how tempting the purchase in front of you happens to be. After 30 years of this, at an average annual market return of 7 to 10%, with the full effect of compounding applied, they have somewhere between $500,000 and over $1 million. Not because they earned more, not because they worked harder, not because they were smarter or luckier or born into better circumstances, because they saw the same $5,000 per year completely differently, because they asked not what they could buy with it, but what it could build. The difference in outcome is not 50% better. It is not twice as good. It is 3 to 6 times as much wealth, from the same income, over the same period, with no meaningful difference in lifestyle during the accumulation phase. That is what a shift in perception produces. That is how much is sitting on the table right now, waiting for the decision to see it differently. But the numbers, as dramatic as they are not the deepest part of what I want to say. Because the reason the deploy model produces such radically different outcomes is not just mathematical. It is psychological. It is behavioral. It is about the dozens of small decisions that happen every month, every week, every day, that are made completely differently by someone who sees money as a resource to deploy versus someone who sees it as a reward to enjoy. And it is in those dozens of small decisions, invisible and unremarkable in isolation, that the entire difference is built. No single decision creates the gap. The gap is the sum of thousands of decisions made from two different models, evaluated in real time against the immediate pressure of circumstance, and producing, over decades, outcomes that are so divergent, they are eventually almost impossible to close. Let me walk you through what I mean. When you see money as a reward for work, a windfall, a bonus, a tax refund, an unexpected extra payment of any kind, produces one primary psychological response. It triggers the spending mode, because a windfall is money you did not plan for, which means it sits outside the normal budget, which means the brain categorizes it as available, which means the question the brain asks is not how do I deploy this, but what do I do with this? And the answer to that question for most people is something in the category of spending, because spending is what money has always been for in the model they are operating inside. The windfall feels like permission. Permission to upgrade, to reward, to finally buy the thing that has been sitting in the wish list, to do the trip that has been postponed. And spending it in this way does not feel irresponsible. It feels deserved. It feels like exactly the right relationship with an unexpected gift from the universe. When you see money as a resource to deploy, a windfall produces a completely different psychological response. It triggers the deployment mode. The question is not what do I do with this, but where does this go? And the answer is almost automatic, because the model already has a framework for where money goes. It goes to work. It goes into the system that is already in motion, the compounding engine that is already turning, the army of dollars that is already in the field. The windfall does not represent an opportunity for a temporary upgrade in lifestyle. It represents an opportunity to accelerate a process that is already producing results, to add more soldiers to an army that is already winning, to push the snowball faster down a hill that it is already rolling down. And the person operating from this model does not experience this choice as sacrifice. They experience it as the obviously correct answer to an obvious question, because the model has made the answer automatic. This difference in automatic response is the whole game. This, not the strategy, not the investment vehicle, not the tax structure, the automatic response. Because strategy can be copied, investment vehicles can be compared and chosen, tax structures can be replicated and optimized. But the automatic response that arises when money presents itself, the immediate, gut level, before you have even consciously thought about it response, that is entirely determined by the model you carry. And the model you carry was installed long before you started making financial decisions, which is why changing it requires more than reading about it, or agreeing with it, or feeling temporarily convinced by someone who explains it clearly. It requires the kind of deep, repeated, experiential rewiring that only comes from actually making different decisions, in real time, against the resistance of the old model, until the new model becomes the one that generates the automatic response. That is the work. It is not exciting work. It is not the kind of work that makes for a compelling story at a dinner party. But it is the work, and the people who do it look, from the outside, like they have some special talent for money. They do not. They have a different model, that is all. That is the entire secret. Now I want to go even deeper into what the deploy model actually means in practice, because I think most people who encounter this idea hear it as being about investing, and investing is part of it, but only part of it. The deploy model is broader and more radical than a preference for investing over spending. It is a fundamentally different relationship with the concept of value itself. The person operating on the earn and spend model thinks of value as something contained in things, in goods, in services, in experiences, in the objects and comforts and pleasures that money can purchase. They accumulate things or experiences. They trade money for value that is delivered in a form they can consume. And consumption is the end point. There is no step after consumption. The value is used and gone, and the cycle begins again with the next paycheck. This is a closed loop. It is self-contained and self-limiting. Every round of the cycle ends at zero. The money is gone, the thing consumed, and the only way to sustain it is to keep earning, which means the only thing that keeps the person financially viable is their own continued labor, which is both the source of everything and the single point of failure for everything. The person operating on the deploy model thinks of value as something produced by systems, and their primary financial activity is not acquiring things that contain value, but building and acquiring systems that produce it. A stock that pays dividends is a system. A business that operates without your daily involvement is a system. A rental property that generates monthly income is a system. A skill set that commands premium pricing in the market is a system. A network of relationships that creates ongoing opportunity is a system. And the wealthy person's financial life is fundamentally about accumulating systems, building the collection of things that produce rather than the collection of things that consume. Every purchase they make is evaluated not only for what it delivers immediately, but for whether it adds to or subtracts from the collection of productive systems they are building. This is not about being miserly or joyless. The wealthy people I have known and admired lived fully and generously and with great pleasure in many domains of life, but their pleasure was not primarily purchased, it was produced by the systems they had built. And that distinction between purchased pleasure and produced pleasure is one of the most important and least discussed differences between the two financial worlds. This is not an abstract philosophical distinction, and it is an enormously practical one that manifests in every category of financial decision. It manifests in how they think about their career. The earn and spend person optimizes their career for income, for the size of the paycheck, for the security of the position, for the prestige of the title. These are reasonable things to optimize for within the earn and spend model. But the deploy person optimizes their career for something different. They optimize for skill acquisition, for network development, for the capabilities that will eventually allow them to produce value independently of any single employer. They are not building a paycheck. They are building productive capacity. They are investing in the system that generates income, not just in the income itself. This means they sometimes take a lower paying role that offers greater learning. It means they invest significant time and sometimes money in developing skills that are not immediately monetized but that will be. It means they think about their career not as a ladder to climb, but as a portfolio to build, where each experience adds to or strengthens the productive capacity that eventually gives them options the earn and spend person cannot imagine. It manifests in how they think about their time. The earn and spend person treats time as something to be sold. They exchange hours for dollars at whatever rate the market offers them, and they think about improving that rate by working more hours or finding a slightly higher paying employer. The deploy person treats time as capital. They ask not just how much does this hour pay, but what does this hour build? They invest time in things that compound, in skills that grow more valuable with use, in relationships that open doors that cannot be opened alone, in projects that may take years to produce returns, but will produce returns that dwarf what any hourly wage could ever deliver. They are extraordinarily protective of the hours that go toward building, because they understand that those hours are not just paid time, they are investment time. And investment time, like investment money, compounds in ways that traded time never can. And it manifests most visibly and most consequentially in how they think about money itself. The earn and spend person sees a dollar as a unit of purchasing power. The deploy person sees a dollar as a unit of productive capacity. $1 today, deployed correctly, is not $1. It is $1 plus the compounded returns of everything that dollar will produce across the rest of time. It is allowed to work, and when you genuinely see money that way, not as an intellectual concept, but as a felt reality, spending becomes a very different experience. Every purchase is not just a transaction, it is a decision about how many future dollars to trade for how much present consumption. And when the math is visible, when the future dollars are real to you rather than abstract, the small purchases that used to happen without thought begin to require justification. Not all of them. Not the ones that genuinely matter to your life and your relationships and your joy, but the ones that happen out of habit, out of boredom, out of social pressure, out of the desire for a brief dopamine hit that is gone by morning and replaced only by the credit card statement. Those purchases, seen through the deploy lens, stop making sense, and that is when your financial behavior begins to change. I want to address something directly now, because I know what the resistance to this sounds like, because I have heard it for decades from the very people who would benefit most from the shift. The resistance sounds like this. That all sounds good for people who have money to deploy, but I am trying to survive. I am trying to cover my rent and my groceries and my car payment and my student loans, and there is nothing left over at the end of the month. How do I deploy money I do not have? This resistance is understandable, and the circumstances that generate it are real, and I am not dismissing them. Financial fragility is real. The structural forces that make it hard to accumulate capital are real. The math of a low income against a high cost of living is genuinely brutal in ways that no mindset shift alone can resolve. All of that is true, and I want to sit with that truth for a moment before continuing, because the person in genuine survival mode needs to be acknowledged before they need to be advised. When you are underwater, the advice to start swimming differently is only useful if delivered with the recognition that you are currently underwater. And here is what else is true. The mindset shift does not require a surplus to begin. It does not require $5,000 a year or 500 or 50. It requires a decision. The decision to see whatever money does pass through your hands, regardless of how little, as something to be considered rather than simply consumed. The decision to ask, before every purchase, whether this is consuming value or building it. The decision to find $20, $10, $5 that can go somewhere that produces rather than somewhere that depletes. Not because $20 will make you rich, but because the habit of the decision is worth more than the amount of the decision. Because every time you make a deploy decision instead of a spend decision, even in a tiny amount, you are practicing the model. You are training the automatic response. For you are building the neural pathway that, over time, begins to generate the deploy response automatically without the friction of having to consciously override the spend response every single time. And here's the piece that most people miss when they argue that the deploy model requires a surplus. The deploy model, applied to human capital rather than financial capital, produces returns that make the financial capital surplus possible. What I mean is this. Deploying $20 into a library card, or a used book, or an online tutorial that teaches you something that makes you more valuable in the market, is deploying into human capital. And the return on human capital investment for someone early in their financial journey is typically many times higher than the return on financial capital investment. You are not choosing between the deploy model and survival. You are choosing between two different forms of deployment, one that pays back slowly and proportionally, and one that pays back faster and asymmetrically. The person who cannot save $500 a month can often still deploy $50 a month into learning something that eventually makes them worth $500 more per month than they were before. And that gap, applied consistently over years, is how people change their income trajectory, which is how they eventually create the surplus that makes financial capital deployment possible at meaningful scale. The sequence matters enormously, but the deploy model applied to human capital first, financial capital second, is the sequence that most people who built wealth from scratch actually followed, whether they named it that way or not. They invested in themselves relentlessly, building skills and knowledge and capabilities until their earning power outpaced their spending, at which point they redirected the growing differential into financial assets that compounded forward. The mindset is the same throughout. The target of deployment changes as the resources available to deploy grow, but the question being asked is always the same. What does this produce? What does this build? Where does this go to make more? There is a particular version of this that I want to spend a moment on, because it is the one that most directly contradicts conventional financial advice, and yet is, in my view, one of the most powerful applications of the deploy model. It is the decision to invest in your own productive capacity before investing in market instruments. For most people in the early stages of their financial lives, the return on investing $1,000 in a skill that dramatically increases their earning power is orders of magnitude higher than the return on investing that same $1,000 in an index fund. The index fund might return 7 to 10% over the long run. The skill might return 500% in the form of a salary increase, or a new income stream, or a business opportunity that would not have been accessible without that capability. This is not an argument against index funds. Index funds are excellent, and I have said so for decades. It is an argument for understanding which deployment produces the highest return at which stage of your financial development. And in the early stages, the return on human capital investment is almost always higher than the return on financial capital investment, which means the deploy model, properly applied, sometimes looks less like investing in the stock market and more like paying for a course, building a skill, launching a project, or developing a capability that expands the scope of what is economically possible for you. And it always, at every stage, regardless of how much or how little you have, looks like asking the question, not what can I buy with this, but what can I build? Let me now talk about the version of this shift that I find most personally compelling, because I think it is the one that is most deeply and most permanently motivating once it is genuinely understood, and that is the relationship between the deploy model and freedom. The earn and spend model, at its core, is a model of permanent dependence. When you earn and spend, the only thing standing between you and financial catastrophe is the continuation of the earning. If the earning stops, for any reason, the spending must stop too, and if the spending cannot stop fast enough, the catastrophe begins. This is not a stable equilibrium. It is a precarious one, that looks stable as long as the conditions that support it remain constant. And conditions never remain constant indefinitely. Into every person who has ever been laid off after decades of loyal service, every person who has ever had a health crisis that interrupted their income, every person who has ever faced a divorce, an economic recession, an industry disruption that made their skills suddenly obsolete, has discovered that the earn and spend model is not a foundation, it is a tightrope. And tightropes, walked for long enough, eventually produce a fall, not because the walker was careless, not because they lost focus or made an error, but because a tightrope is not a floor, regardless of how long you successfully walk it. The deploy model, over time, builds something fundamentally different. It builds redundancy, it builds a growing base of assets that continue to produce, regardless of whether you personally show up and perform. The deployed dollars do not care if you are sick, they do not take days off. They are not subject to the political dynamics of an organization that might decide to eliminate your position. They do not care if your industry gets disrupted by technology or globalization or some development that nobody predicted 5 years ago. They just continue to compound, continue to produce, continue to add to the base that eventually, if the deployment is consistent enough and the timeline long enough, reaches the point where it covers your needs without your active participation. And when that point arrives, something shifts that no amount of income ever produces in the earn and spend model. Your labor becomes optional, not worthless, not unwanted, optional. And optional labor is the most valuable kind, because it is chosen rather than compelled. Because you do it because you find meaning or joy or engagement in it, not because the alternative is an inability to pay your rent. And work that is chosen from a position of security produces a different quality of output than work that is compelled from a position of fear. The person who works because they want to brings something to their work that the person who works because they must cannot consistently sustain. That difference shows up in the quality of what they produce, and, over time, in the income that production generates. That is what the deploy model is ultimately aimed at. Not a bigger number in a brokerage account, not a portfolio to show off at dinner parties, not the ability to buy nicer things, or live in a larger house, or drive a more impressive car. The deploy model is aimed at the specific, measurable, structural condition of having built enough productive systems that your financial survival is no longer dependent on your continued performance. Freedom, real freedom, not the word on a motivational poster, the thing itself. The thing that changes how you walk into every room and every negotiation and every conversation about your career, because you are there because you chose to be, rather than because you had to be. And that change, from compelled to chosen, from fear-driven to value-driven, from tightrope to solid ground, is the deepest return the deploy model generates. The financial return is the one you can measure. The freedom return is the one that changes everything else. I want to be honest about the timeline of that freedom, because dishonesty about timelines is one of the things I find most corrosive about popular financial content. The deploy model does not produce freedom in a year. For most people starting from ordinary circumstances, building a base large enough to be genuinely self-sustaining takes a decade or more of consistent, disciplined deployment. That is a long time. That is a longer time than most people want to hear about when they are looking for relief from a problem that feels urgent right now. But I want to offer you a perspective on that timeline that most people never encounter. The decade passes regardless of what you do with it. 10 years from now exists whether you decide to change your model today or not. The question is only what you are standing on when you arrive there. Whether those 10 years of passing produce nothing but a slightly older version of the same financial situation, or whether they produce something underneath you, something that grew while you were not watching it. Something that compounds forward into the decade after that, and the one after that, until the thing you built is no longer small, and quietly growing but large and loudly working, doing in a single year what you used to have to work for months to accomplish. That is the promise of the deploy model. Not that it is easy, not that it is fast, but that it works, consistently, across every income level that produces any surplus at all, across every time period, across every economic environment, not in every individual year, because markets fluctuate, and economies cycle, and the short term is always unpredictable, but across the long arc, that is the only arc that actually matters for building real, lasting wealth. It works because the mathematics of compound growth are not negotiable. They do not care about your feelings about money, or your history with it, or how many times you have tried and fallen short before. They just work. They just compound. They just produce, silently and relentlessly, the outcomes that the model is aimed at. Your only job is to stay inside the model long enough for the math to do what the math does. I want to close with something that goes beyond the financial, because I think the deepest version of this shift is not really about money at all. Money is the domain where it is most visible and most measurable. But the shift from earn and spend to deploy is, at its core, a shift in how you relate to time itself. The earn and spend model is a present tense model. It asks, what does this do for me now? The deploy model is a future tense model. It asks, what does this build for the person I am becoming? And that difference in temporal orientation touches every area of life, not just finances. The person who deploys thinks about how this conversation builds a relationship that matters in 10 years. They think about how this skill they are developing today changes what is possible for them in 5 years. They think about how this decision they are making right now, however small, sits inside a longer arc that they are deliberately shaping rather than simply inhabiting. That is the mindset of the wealthy, not greed, not ruthlessness, not the absence of generosity or warmth or enjoyment of life. The wealthy people I have known and admired most have been some of the most generous, most curious, most fully alive people I have encountered. What made them different was not what they sacrificed, but what they decided to optimize for. They optimized for the long arc. They optimized for the building rather than the buying. They optimized for the future self who would benefit from the present self's discipline. And they made that future self real and present and important enough that the present self would not casually betray them by spending what was meant to be deployed. That is the shift. Not complicated, not secret, not available only to people with certain advantages, or certain levels of education, or certain amounts of starting capital. Available to anyone with the clarity to see money differently, and the courage to act on what they see, even when the people around them are doing something else entirely, even when the old model pulls hard toward the familiar, even when the gap between the two futures feels too abstract and too distant to justify the sacrifice of the present moment. See it differently. Just that. From that single change in how you see it, every other decision follows, differently than before, building something that looks impossible from inside the earn and spend model, and inevitable from inside the deploy model. That is how different these two worlds are, and the distance between them is exactly one shift in perspective, available right now, wherever you are, however much or little you have, starting with the very next dollar that passes through your hands, and the single question you choose to ask about it. What does this build? Start there, because there is nowhere else to start that leads anywhere worth going.